You're listening to the Beyond 50 radio program, and thank you for joining us today. I'm your host, Daniel Davis. We're moving into a wonderful time where there are opportunities abound when it comes to stretching outside of the United States with a declining dollar and trying to find ways that we can take our money and make it stretch a little further and invest in opportunities that are even sometimes seemingly beyond our reach. Joining us here on the Beyond 50 radio program today is financial reporter of the Wall Street Journal, Jeff Opdyke, and he's joining us today here on the Beyond 50 radio program to talk about his new book, The World is Your Oyster, how you can find opportunities outside the United States to invest in this new global economy that is now right on our doorstep. So we're going to be talking about that today, what the opportunities are, what some of the risks are, and what some of the financial rewards are abound when you take this opportunity to do so yourself. And we'd like to welcome Jeff Opdyke to the Beyond 50 radio program. Jeff, thank you for joining us today.
Thanks for having me. Glad to be here.
Now, I like the title of your book.
Well, thank you. I mean, it really is true that the world is your oyster once you go outside and start looking around for it.
Yeah, I'll bet. Now, you've been with the Wall Street Journal, as I understand, for about 15 years, but you've been doing, I guess, global investing, as I understand, for at least 10 years, so you really kind of know what's going on out there. Now, when people listen to brokerage people, they tend to say kind of keep your money inside the U.S., keep it domestic, keep the dollar strong, so forth and so on. But you're pretty much saying, no, it's time to stretch and go beyond what we know and what we feel comfortable about. Explain why this is important for people to know.
Yeah, actually I've been doing this for about 13 years now. I opened my first account in New Zealand in 1995. And to be really clear about this, when I'm talking about global investing, I am talking about investing directly overseas. I'm not talking about buying ADRs in America, and I'm not talking about buying mutual funds here that invest overseas. I'm talking about physically putting your money to work in foreign economies because that's where the greatest diversification benefit comes from. It does not come from U.S.-based mutual funds that invest overseas. The process is really quite easy. If you were to talk to your stockbroker today, they would probably tell you not to do this, that it's way too risky, that you can't control all these variables that happen overseas. You got to send your money to foreign lands, and you don't have easy access to it. It's just not true. I mean, I've been doing this for 15 years. I have accounts in New Zealand, Australia, Singapore, Hong Kong, recently Egypt and Dubai, and about to open one in Vietnam. It is that easy to invest globally. There are risks. There's no doubt about it. You certainly face a variety of risks going overseas, but you face many of those same risks here in the U.S. People just don't stop to pay attention to it.
I think what's interesting, too, when we talk about risk, especially if you're sitting in front of a broker that just can't wait to get his hands on your money and decide where it's going to go for the best possible spread, usually when it comes to his own percentage, is when they use the word risk, it kind of pushes people into a fair position rather than thinking optimally about what they're supposed to do. So one of the best ways I would think that you can kind of at least reduce the risk is by doing your homework, and I know that you advise people to do that, especially in your book, The World is Your Oyster.
Right, yeah, the book is really a Lonely Planet guidebook to global investing. When I started doing this, 13 years ago, there was no book for this. In fact, I went looking for it. I've been looking for it ever since. And I got to the point where I just said, you know what, I have the expertise now where I can write this book. And so this book really walks you through the process of finding a brokerage firm overseas willing to work with U.S. investors and how you communicate with them. It walks you through the process of researching companies and countries and economies and understanding what you're getting involved with. It shows you all the research options that exist out there everywhere, everything from the company websites themselves, which are just a plethora of information and data these days, through all these research opportunities that exist in third-party research firms and brokerage houses overseas and whatnot. And there are some very good brokerage houses overseas with some very good research coming out of them. So this is really sort of your guidebook. I mean, if you were to go to Japan tomorrow, you would probably want a little guidebook that sort of walks you through how to get around Tokyo, which can be a very difficult place to get around. This is that book for investing. It walks you through the process and shows you how to get around.
Now, I'd like to maybe make it clear for our listeners out there now, why is it important to become an investor in the global economy?
Okay,
I mean, it seems like there's a screaming obvious answer, but I'm sure there's a lot better ones than just because you need to get involved with what's going on instead of staying here within your own chicken coop, so to speak.
I mean, so look at the U.S. today. I mean, we have an economy that is limping towards recession if it's not already there. you have a weak currency that has potential to go weaker based upon the huge budget imbalances we have in this country, and you have a stock market that is struggling these days to figure out what it wants to do, and it's down from its highs sharply. You look around the world and you don't find those same things happening. You find countries like China that have just a tremendous amount of growth in front of them, particularly in their sort of domestic consumption, which is growing very, very rapidly these days. You have currencies around the world that are much stronger than in the U.S. and are gaining value against the U.S., and you have stock markets that, while the U.S. is down, they're up overseas. So what we're saying is, look, you need to be diversified away from the U.S. economy. Yes, you can keep the bulk of your assets here. That's fine. I'm not saying completely abandon the U.S. That's not the point. The point is to take what you have and make it better by owning access to foreign economies. And when you do that, you diversify your portfolio, you diversify the stocks you own, you diversify the economies you're in, the currencies you're in, the countries you're in. That is going to create some stability in your portfolio, and statistically speaking, it will improve your returns. So what you are doing is actually reducing risk and improving returns, and there's just a host of academic data that bears this out.
Now, as someone listening decides, this sounds interesting to me, I've got a money manager, I'm going to go ahead and I'm going to sit down with them and I'm going to let them know what my intentions are in kind of stepping outside of the United States. What are some of the things, I guess, call it even a tactic, if you will, that this particular fund manager might say as a ploy to discourage somebody from taking that necessary step?
The first thing they're going to tell you is it's too risky.
See, that's the big thing. It's always the fear. Keep your money in my pocket, not somebody else's.
Exactly. I guarantee you the first thing they'll say is it's too risky. I'm here to tell you that, yes, there are risks, but it's not too risky. I have some of my money today invested directly in China in their B share market. And yes, it can be volatile. It can whipsaw you around. There's no doubt about that. But the companies themselves are very good companies, and they continue to generate increasing amounts of profit. And as long as you have the stomach to deal with some of the potholes that will happen, and as long as you realize that you are a long-term investor, that you're not here to play China because it's the hot market today, you're here to play China because it's going to be a leading market, several years from now, then it's okay. You can tolerate the risks that you're going to face. You also have to realize that the risks that are inherent overseas, such as let's say political risk. There's a lot of political risk in a place like China, or at least in theory. The same kinds of risks exist here in the U.S. in various ways. And I'll point to a big one that most people probably don't even pay attention to, but when the Clinton administration first came into office back in the early 90s, one of the first things they did was take on, healthcare. That was their big political policy. We're going to take on healthcare. And what happened? Pharmaceutical stocks got absolutely destroyed. That was a huge risk that you probably didn't expect before the Clintons came into power. They come into power, and suddenly your healthcare stocks are getting absolutely destroyed. Those kind of risks exist here in the U.S. Accounting risk exists here in the U.S. Let's just look at Enron and Adelphia for a moment. So the risks you face overseas are very real. There's no doubt about it. But the risks you face in the U.S. are similar. People talk about currency risk overseas. You're going into this bizarre currency, and you're going to face a risk there. Well, that's true. But then again, the fact that the U.S. dollar is falling as dramatically as it's fallen is a big risk to you right now, this very moment in your pocketbook, because all those widgets that China is making and shipping to Walmart are suddenly more expensive for you. So you face risks here. So don't let some money manager tell you you can't go overseas on your own because it's too risky. It's just not true. If you go find good companies with products that you believe in, and you're not just trying to take a flyer on some new technology company based in, Kazakhstan, you can be a successful overseas global investor. It's very simple. Just think about what you as a middle-class American thrive on and want every day, and I guarantee you there is a foreign company providing that exact same product and service to a middle-class Chinese person, to a middle-class, Dubai person, to a middle-class South African who who wants the exact same thing, and that company is making the same kind of profit overseas as the local company is making here in the States. But the only difference is that you can't trade that company in America. You have to go overseas to trade it, and that's where the real opportunities are.
Now, Jeff, what you were saying earlier, that you're being a long-term investor, I'd like for you to describe to our listening audience what that means, because a lot of times what people think when they get into the stock market is they're going to buy low, sell high. Hopefully for a quick turn. It could be a day, week, maybe a month, maybe even 6 months. But that's the typical language you hear. So I could just see someone sitting in front of their brokerage manager or their money manager, fund manager, and the first thing out of their mouth is it's riskier. They might even try a different play. Well, that's okay, but you might want to try this hot company over here in America, sort of a thing. So you can see where greed really falls into play and the common sense goes out of trying to research and find out what is my long-term strategy and long-term goals. And I think sometimes people just don't have those, and I know you talk about that in your book.
Yeah, I'll tell you, my long-term, or my idea of long-term investing is this: buy low, sell never. I buy companies I believe in, and I buy them with the expectation that I'm not going to have to sell them.
Buy low, sell never. See, that's the first time you've heard somebody actually say something like that.
Warren Buffett had this great phrase, and I'm going to have to paraphrase it because I can't remember it exactly. But he says, one of the greatest investment strategies is, sloth bordering on lethargy. It's so true. I mean, if you find a good company that is consistently profitable, that pays you a dividend, why get rid of it? Why are you trying to sort of do better? I bought my first stocks in New Zealand in 1995, and I haven't sold them yet. And along the way, I'll tell you, the name of the company was Fisher & Paykel. They make what is now a very popular dishwasher here in the U.S. called the Dish Drawer.
Wow.
But they were not in the U.S. when I was buying into these guys. But I bought them at a level that I thought was really cheap. In fact, when I tried to buy them the first time, my broker in New Zealand laughed at me and said, "Why would you want to own that dog?" And I said, because that dog has a lot of hunt left in him. And turns out, I've owned this thing for 13 years, and I have a compounded annual return of basically 15 to 16% a year. The stock has paid me in dividends and special distributions 40% more than my original purchase price. It has spun off a very profitable healthcare division that is paying its own dividends to me these days.
Wow.
I mean, these are the opportunities that exist overseas. Yes, it was risky going to New Zealand in 1995. Even the Australians I was talking to say, "Wow, that's the Wild West." But it turns out it's been a very, very good market.
Yeah, it's just so exciting because it's funny to hear people as they go out and they decide that they want to get into the stock market, and just even listening to the language, you can kind of understand, well, I don't really think you know what you're doing, or at least wherever you got your education from, you're kind of off track here. So you can see how when somebody stamps the word risk in their face, oh, then what should I do? Pretty soon they just don't know what to do with their money. Now, when we talk about the risks in investing overseas versus in the United States, you say that really the differences aren't that different. Let's talk about what some of those things are and just really how similar they can be.
Well, which one you want to talk about? I mean, there's so many different possibilities.
You just go ahead and pick from your plethora there.
Well, like I mentioned, you have the currency risk. People are worried about, the falling U.S. dollar. Well, okay, so a way to combat the falling U.S. dollar is to be invested overseas because, currency moves in pairs. It's a seesaw action, so that as one goes down, the other, by definition, has to go up. So if the U.S. dollar is falling and you have accounts with assets that are denominated in New Zealand dollars and Australian dollars and Chinese yuan and whatever, those accounts are gaining in value even if the stocks never move. It's because the U.S. dollar is falling. Conversely, if the U.S. dollar starts rising, then those accounts will, be worth less because, those currencies are going to be worth less. Personally, I don't look at short-term currency trends. I mean, it's just impossible to predict that kind of stuff. Economists try to do it all the time, and they get it wrong about 105% of the time. I look at the idea, I want to own access to or exposure to foreign economies. I want to own exposure to foreign currencies, and I want to own exposure to foreign companies. And the way to do that is through a foreign brokerage account. You go to a mutual fund here in America that is, say, Asia-specific, and you go tear it apart and look at the companies it owns, you're going to find in there Toyota, Sony, Samsung, Hyundai, these big companies, HSBC, the big Chinese bank, or I guess it's really a British bank, but with big Asian operations. But those companies are huge global players with a big presence in America. So if the U.S. is sliding into a recession, what benefit is it to you that Sony suffers from the fall off of the U.S. spending of the U.S. consumer? It doesn't benefit you at all. I would much rather own local Japanese companies that are benefiting from local Japanese growth, or more importantly, companies that are benefiting in Japan from China's growth, and there are a number of those, because those are, pure plays on Asia. They're not plays on America. I don't want a backdoor play on America. I want a front door play on Asia.
Well, that makes a lot of sense, actually, when you think about it.
Yeah, and that's the problem most people don't realize. A lot of folks will play the ADR market. If you go to your manager, your fund manager today and say, I want to own foreign companies, he's going to steer you to the ADR market. That's great. However, the problem is the ADR market is the same thing. You're going to be buying Toyota. You're going to be buying, Sony. You're going to be buying Philips Electronic out of the Netherlands. These are great companies. There's nothing wrong with them. It's just that they are as much American as they are foreign.
Right.
I don't benefit from that. I don't want.
It's almost like there's a filter right there that really keeps you from making the kind of money that you can be, where it's more direct and local, as you're talking about.
Exactly. The other idea with it, and I've talked to some researchers from Ohio State University about this who have tracked it, is that the ADR market in America, once a company starts trading there, they begin to have a tie to the American market overall. So that if, I'm just going to use Sony again as an example, if Sony in Japan were actually up for the day, if the U.S. market is tanking, they're going to sell off Sony here, because it is a stock in an American portfolio, and when the U.S. market is tanking, Americans aren't thinking, oh, well, this is a Japanese company, I'm going to keep this one, but I'm going to sell Merck instead. They don't do that. They just sell willy-nilly. It doesn't matter where you're based. So you get ADRs that begin to trade much more like American shares than they do local Japanese shares. And people want to talk multinationals. You want to be an international investor, good, let's do it the safe way. Let's own McDonald's and let's own Intel and all these companies that sell a bunch of products overseas. That's fine. But statistically speaking, again, when you follow what those companies do, they tend to track the S&P 500 much more so than they track global stock markets, because they are American companies first and foremost. So that if the American economy is suffering, people are going to be selling American stocks because they're scared about the American economy. They're not going to, say, oh, well, I'm not going to sell McDonald's because, McDonald's gets a lot of its money from Karachi, Pakistan, and Tokyo and Hong Kong. Mm-hmm. They don't think that way. They think first and foremost about, I got to sell my stocks, I'm selling McDonald's. That's just the way it works with multinationals. So if you're going to be an international investor, you got to go where the international stocks are, where the foreign stocks are, and that means you got to go overseas.
Well, it seems to me, too, that if you go along that trajectory of thinking, that you're actually going to decrease your risk by investing in a company that's working more locally, as you're talking about, rather than one that's kind of scattered between many different countries, per se. That's almost like getting into a bad mutual fund where one company out of the 7 is doing well.
Yeah, it's not so much across multiple countries, because, there are some great opportunities in Singapore these days among some of the REITs there. They own real estate operations all over various parts of Asia and into Australia. There's a company in Dubai called Emaar Properties, which, if it listed here in the U.S., would be the largest real estate company in America. They operate real estate properties like housing developments, shopping malls, and commercial centers from Southeast Asia all the way across to Central Europe. So it's not necessarily that I want just sole coverage in Thailand or just sole coverage in New Zealand. It's that I want companies that don't have American ties, because they're not going to be tied to the American consumer. I want them to be tied to growing markets outside of America.
Okay, well, that makes enough sense. Now, as the people listening, what are some ways that you suggest in your book that you can go ahead and share with our listeners of how a person can choose the right kinds of companies overseas?
It really depends on who you are, because there are going to be people who are accepting of risk, going to be very risk tolerant, and they're going to go into a place like Hong Kong, and they're going to see a company like Water Oasis Group, which is a Hong Kong traded Chinese stock. They're an entrepreneurial company. They operate beauty stores basically inside the big malls in China. It's high-end cosmetics.
Ah.
And when you think about it, here you are in a country with 1.3 billion people, half of which are women. You're in a country where there is a growing amount of disposable income. China sort of reached that tipping point where there's enough disposable income to actually drive a domestic consumption economy now. And you have these cities like Shanghai, Beijing, Guangzhou, and some others that are very, very urban, that are very, very sort of, professional cities. And all these women, and what do women like? They love cosmetics. I mean, why would you not own a cosmetics company, a cosmetics retailer in China that is, has a huge following among Chinese consumers? It's a riskier play. It's a small cap company in an emerging economy like China, so you have to be a risk-tolerant investor. But at the opposite end of the spectrum, you can be a conservative investor, and you can go to some place like Australia, which is a very stable market. It has a very strong economy that's tied to China because of the commodities boom, and it's a multi-year boom. And you can find companies like Macquarie Group, which is one of the giant banks down there that has been hard hit by the credit crisis globally, but is definitely not going away. It's a fantastic company, and it's a much more conservative play than Water Oasis Group. So it really depends on who you are and what type of investor you are, and the kinds of risks you're willing to take.
So the most important thing for the listeners out there is first understand what kind of an investor you are before you make any other move, and try not to be sitting there listening to somebody who's trying to tell you where to move your money without doing any kind of research. Now, you describe how a person can go about finding out more about these companies. Now, is it pretty tough? I mean, when you're looking overseas at a company, where do you find that kind of information?
There is a ton of information. The Internet these days has made being your own stock market analyst very simple. When I started in '95 in New Zealand, there was nobody offering much on the Internet. There was no online brokerage firms overseas for the most part. It was very difficult to find research. I did most of my research by finding online newspapers and, sort of building a database of what kind of companies trade overseas. And the ones I liked, I would send emails to their corporate communications department. They would send me a bunch of annual reports back in the mail, weeks later, and I was doing research that way. Today, it's very, very simple. All of this stuff is online. You can go to just about any company in the world. They're going to have an online website. They're going to have an English shadow. If they don't speak English as a common language there, they're going to have an English shadow version of their website that's going to have all kinds of information about them. They're going to have their annual and quarterly or half or semi-annual reports online. You can download those really quickly. You can find third-party research all over the Internet. You can find newspapers all over the place these days that offer really good sort of insightful articles about companies and industries and trends that are taking place. I mean, it's just a wealth of information that's out there these days online that basically means you can become your own stock market analyst. And being an analyst, I have to say, analyzing stocks is not some sort of highfalutin MBA Wharton kind of thing. Honest to God, I have a journalism degree from Louisiana State University. I'm not an MBA. I'm not some sort of analyst. I am just your average investor who knows that there's great opportunities overseas. And researching stocks really boils down to a very simple equation. Do you understand the company? Do you know what they're selling? And is there a demand, an ongoing need for what these guys provide? If the answer to all those is yes, then you probably have a decent company to look at. And then it's just a matter of looking at the numbers and seeing if they make sense. I mean, you don't have to do all kind of cash flow analysis and all that kind of stuff. You just have to look and see, have revenues been growing? Is the earnings, or are the earnings growing? Are they paying a dividend? If a company's paying a dividend, you at least know some portion of their earnings are real, because, while you can make up, all kind of numbers for earnings, you can't make up a dividend check. I mean, it is what it is. So if somebody's paying you a dividend, you have to believe that a good part of their business really is real. So it's not that difficult to pick stocks. I mean, Peter Lynch said it best in his book One Up on Wall Street way back in the 90s. If you can draw with a crayon what this company does, you understand the business. And that's pretty much all it takes to be a successful investor. Understand the business. If you don't understand...
Well, it seems to me, too, that that's a good piece of advice for somebody who might even find somebody who would be a fund manager is, can they explain this to you or share the information with you that's simple to understand rather than complicating it to where you tend to actually react and make choices through fear, which is what most of them tend to do.
Absolutely. I mean, if you're talking to any financial pro and they're talking to you in a level that is above your head, don't be scared. Just say, wait a minute, I don't understand what you're talking about. Explain this to me like you were trying to explain it to your grandmother. If they can do that, and if you can buy into what they're saying and you understand it, and don't pretend you understand it. The worst thing I see people do is hear financial pros talking at them, and nobody wants to seem like they're sort of incompetent or stupid or whatever. Say, oh yeah, I understand. When they really don't. If you don't understand, that's fine. You don't understand. Some of this stuff can be complicated. And even after you have heard the explanation 3 or 4 or 5 times, if it still doesn't make sense to you, then don't worry about it. Don't invest there. It's not for you. I don't understand nanotechnology. I've tried to understand nanotechnology. It's way too complicated. I'm not going to go stick a bunch of my money in nanotech stocks these days. They just don't make sense to me. Beer makes a whole lot of sense to me. So does milk. I understand milk very well. And there's a great company in China called Mengnu Dairies. It's out of Inner Mongolia, and they are doing bang-up business in China selling milk to the Chinese because they have this huge appetite these days for dairy products. I understand that. Very simple. Cheese, milk, eggs. I got it. I understand it completely. Very simple stuff to understand.
That's great. Another thing, too, I was thinking that occurred to me in The World is Your Oyster is the fact that one of the chic things that you see some investors doing this day and age, and actually they've probably been doing it for about 15 to 20 years, is, investing in Hollywood and movies because you can get a great return on your money if the movie hits. Well, there's the risk. Will the movie hit? And when you look at that, are there opportunities for people to actually invest when you think about India and Bollywood, or you think about Hong Kong and the Hong Kong films, which do phenomenally well? Are there opportunities like that? I mean, have you seen anything like that?
A couple of comments here. First, India is really, really challenging. It is closed effectively. You cannot invest as a non-resident Indian. So basically, as a foreigner, you can't invest in the Indian stock market.
I see. Okay.
So it's sort of out of the question. I would never invest directly in the movie business. I've actually talked to.
It was just something that occurred to me. That's all. So.
Yeah. It's a very risky thing. But there are ways to play. I mean, there are cinema companies in China and Hong Kong who are benefiting from the growing demand for entertainment because China is now moving to a 5-day, 40-hour work week policy. As that happens, suddenly you have people with a whole lot of free time to pursue leisure activities. Movies is going to benefit from that. So that's another way of effectively or basically the overarching theme of my book as an investor is really very simple, which is this. There is a middle class emerging all over the world. And if you want to benefit as an investor, think in terms of the middle class. The greatest growth that happened in the U.S. is the growth of the middle class. I mean, that's where all the consumer demand stems from. It's the exact same thing happening all over the world these days. I've pointed out a couple of times to people that there's a company in South Africa called CK Holdings, SEAKAY, and they are building starter homes for black South Africans. And black South Africans is a big emerging middle class in South Africa. And here you have this company that is servicing their needs for homes. That's a great investment opportunity. Those are the kinds of things I look for as an investor. I think in terms of what does the middle class want, what is the middle class going to pursue, and who is making those products. That's what originally led me to Fisher & Paykel in New Zealand, because as Asia is emerging, they want the same Western standards that, in their homes that we have in America, and that's dishwasher, stoves, refrigerators, those kind of things. And Fisher & Paykel is servicing that need. I mean, that to me is, a legitimate investment theme.
For those of you joining us, the book is The World is Your Oyster, and how you can, it's the guide to finding great investments around the globe. And our guest joining us here on the Beyond 50 radio program today is Jeff Opdyke, reporter of the Wall Street Journal, who has been doing this for about 10 years. So he really knows what he's talking about. The book has a lot of common sense, which I really enjoy, especially when it comes to money and investing money. In closing with the show, what would be your one staple of investment advice that you could share with our listeners, even if they're doing it domestically, but more importantly, as they begin to stretch their wings and perhaps fly outside of the United States?
Yeah, and no matter where you go in the world as an investor, think in terms of owning a company. I mean, when you buy a piece of stock or you buy a share of stock, you are buying a piece of a company. You're buying a business. You're not buying a lottery ticket. You're not buying the chance at turning $1 into millions. Mm-hmm. You're buying an ongoing revenue stream from a company that hopefully you believe in and you want to be an owner of long term. You know, if you own a pizza business in Portland and suddenly pepperoni prices are too high, are you going to sort of just throw your hands up and say, that's it for the pizza business, I no longer want to own pizza, I'm going to go start my own sandwich company now? I mean, you don't do that. You own a company, you work through the hard times, you work through the good times. Buy a business, don't buy a lottery ticket.
Very good. And where can people find this book?
Oh, it's all over the place. All the local bookstores have it, hopefully, in multiple copies, and Amazon.com, they have it.
Well, very good. Well, Jeff Opdyke, it was a pleasure to have you on our program today, and it sounds very encouraging that should be our very next step, is to start stretching beyond domesticity and getting out there and, kind of taking advantage to the growing middle classes around the world, and the book is very encouraging. We want to thank you for being on our program today.
Hey, no problem. Thanks for having me.
You bet. Again, the book is The World is Your Oyster, and our guest today joining us is Jeff Opdyke, the reporter of the Wall Street Journal. I'm Daniel Davis. Thank you for joining us today. You've been listening to the Beyond 50 radio program. Be sure to visit us at our website, beyond50radio.com. That is the number 50, beyond50radio.com. And visit our blog where we'll have some information and a nice little synopsis of what we've been talking about here today on the book, The World is Your Oyster. I'm Daniel Davis. Thank you for joining us. And remember, live your day past halfway.